Good morning, this is Eric with Low VA Rates. I guess depending on when you're watching this video, good afternoon, good evening, but I hope you're having a great day wherever and whatever time it is. We're going to talk to you about something I'm super excited about today because we have not talked about this nearly enough at Low VA Rates, and we should. And that is how reducing the term of your VA loan can help you win big. We all love winning, okay? I'm going to give you what I call my 3-ingredient recipe for success. Please watch this video in its entirety. I promise I'm not going to ramble on for more than probably 5 to 7 minutes, and you will leave watching this video with a much better idea of how you can win on your mortgage. Okay, bear with me. This is a super important topic. Number 1 ingredient in this 3-ingredient list is a lower interest rate. Number 2 is a shorter term, and number 3 are extra payments. We're going to dive into each one of those right now. Why a lower interest rate? Well, for most of it, this is probably common sense. And let me remind you who you're watching today. Low VA Rates. Low rates. Ask our agents about our $250 guarantee. You can have super amounts of confidence that you are getting the absolute lowest rate possible on your VA mortgage when working with a company like Low VA Rates. Now, why do we want a low rate for success on our mortgage? Well, the lower the rate, that is your interest rate, the less interest you will pay no matter what, no questions asked. If someone's telling you otherwise, oh, you don't need to worry about getting a lower rate. We've got all these other, amazing customer service, and check out our logo and look at the basketball team that we're a part of. I don't know what they would tell you, but if they're trying to convince you that a low rate is not important, you need to be very skeptical. It is important. If someone told you 1 + 1 no longer equaled 2, you should probably also question their mentality there. So, very important. Let's look at some real-life examples. I think that's the best part about this. The math doesn't lie. If you took a $250,000 mortgage or loan at 4.75% and you compared it to a $250,000 loan at 2.75%, guess what? You're going to pay a heck of a lot less interest the lower your interest rate is. So, for example, 4.75% is going to cost you almost $470,000 for this $250,000 house by the time you're done paying all that interest. A 2.75% interest rate, for example, is only going to cost you $367,000 for that same $250,000 mortgage. Now, if you would like to know what interest rate you qualify for, you need to talk to a licensed loan officer. This is simply an example of how the lower rate affects the amount of interest you pay. Now, you don't have to take my word for it. You could simply go to Google or Yahoo or whatever search engine you want, and you could type in mortgage amortization calculator. We have them on our website. Your loan officer here at Low VA Rates can provide you with some links. However, I wanted a non-interested, non-biased third party so that you knew I was only giving you unbiased information. Facts. A $250,000 mortgage for 30 years at 4.75, you're going to pay almost $470,000 for your home. Look at how much interest you're going to pay. Looks like almost twice the amount in interest. Okay? Or it looks like half of what you're paying is interest. That's what I meant to say. If you do the exact same thing at 275, you're paying $117,000 in interest compared to $219,000. So over $100,000 in interest is saved. Hence, you only pay $367,000 for your home if you take advantage of a lower interest rate. So go play with that and figure out for yourself that the lower the rate, the less you're going to pay in interest. Now, second thing, just as important and also very correlated to the lower interest rate is the term and how that can affect things. The longer you take to pay someone back, when they're paying you interest, the more you're going to pay them. If your buddy lends you $100 and just says, pay me back when you can, it doesn't matter if you pay him back the following weekend or if you pay him back 5 years later, other than he might really question your loyalty. You don't have any interest, it doesn't matter. However, if your buddy says, yeah, I'll give you $100, but you're going to pay me 10% interest every single month, or every day or every year, you're going to want to pay him back as quickly as you can to minimize how much money you're going to end up having to pay him back. Now, here's the real key. Lenders, like low VA rates. They charge a lower interest rate on shorter terms. So you're always going to have lower interest rates on a 15-year mortgage than you will, let's say, a 30-year mortgage. Okay, that's just part of the equation. That's a correlation that we cannot get around, and just know that. And we'll talk about that a little bit more here. So let's go see another real-life example, okay? Here you go. If you have a 15-year loan at 2.75%, now, is that possible? Yeah, because on a 15-year loan, you're going to get lower interest rates. Now, again, if you want an accurate quote from a licensed loan officer, you need to give us a call. If you compared that 15-year loan to a 30-year loan, now you cannot get as low of a rate on a 30-year loan as you can a 15-year loan. So that's why I got two interest rates here. It's a compounding effect. I'm going to show you how a shortened term saves you lots of money. We've already explained that right here, but when given the shorter term, you're also given a lower interest rate, so it's like you're double dipping. It's that much more compounding and effective. So check this out. Essentially, you will save $164,000 in interest, or you will lose $164,000 in interest if you choose the higher rate for the longer term. It's always going to save you interest if you do a shorter term. And again, you don't need to take my word for it. I'm back to the amortization calculator, and this time I did $250,000 for 15 years at 2.75 versus $250,000 for 30 years at 4.75. And look at this. Again, at 4.75, we're paying $219,000 in interest. Here, on a 15-year loan, look at this. Look at how much less interest we're paying. If you remember, we go back here to the 2.75, 30-year, $117,000. So the exact same interest rate. If we cut 15 years off of our loan, look at what happens to the interest paid. It is phenomenal. What a great opportunity. So again, I hope that really drives home the impact that a shorter term can have on your mortgage. Now, secret ingredient number 3, what I like to call the icing on the cake, is these extra payments. And keep in mind, extra payments work on both a 30-year loan or a 15-year loan. But if we're talking about real success today, we really need to focus on these shorter term loans at lower interest rates. But every time you make an extra payment, it essentially shortens your term even further. So if you make extra payments on a 15-year mortgage, you might pay that mortgage off in 14 years or 13 years, and the exact same thing happens. It just happens even better for you. Okay? Extra payments shorten your term. Let's once again see a real-life example. A $250,000 loan at 4.75% with just $100 extra payment a month can save you almost 40 bucks. Sorry, let's pause. Okay, that was funny, but with technology, look how quickly we can fix things. Taking a $250,000 loan at 4.75 and just adding an extra $100 a month could save you almost $40,000. And like I say, you don't always have to take my word for it. You actually almost never have to take my word for it. So let's go look here. Here is, I just went into Google and I typed in extra payment mortgage calculator, and I typed the same sort of stuff in here. Okay, if I do a $250,000 mortgage at 4.75% for 30 years, but I make an extra payment every month, and here's kind of how that works. Let me show you here. 250, 475, 30 years, $100 additional payment. I can hit calculate, and look at this. Instead of paying the loan off in 30 years, I shortened my term. How? Well, all I did is I made an extra $100 payment every month, and I paid my loan off almost 5 years early, saving myself almost $36,000. On the prior slide, of course, I rounded it up just to be giving you an example, and that's the benefit of extra payments. So every time you make an extra payment, your loan balance goes down faster because 100% of that money goes towards the balance, your principal balance that you owe, and not any of it goes towards interest. You see, the bank can never take more interest than they're allowed to take, and you can force them to take additional principal, allowing you to pay your loan off quickly. Now, here we are. This is a secret ingredient right off the top. Get out of debt as fast as you can with a shorter term. It's amazing. let's look at the very first example I gave you guys. And I'm not going to go to a real life example on the web because you already now should have those tools. But if we take a $250,000 30-year loan versus a $250,000 15-year loan, check out what happens. Now, we already know the lower the term, the lower the interest. So I'm going to give you the benefit of taking a lower term. You're getting a lower interest rate, higher term, higher interest rate. Look what happens at your balance, to your balance, just 5 years into the mortgage. Your balance on this $250,000 loan, you only owe $176,000. At the end of 5 years, you've paid $52,000 off of your balance. Where if you do the traditional 30-year loan at the higher rate, you're only going to have your balance paid down from $250,000 to $228,000. You're wasting all your money on interest or losing $52,000. The bank is taking $52,000 more from you than they needed to. So please, number one, thank you for watching, but talk to your loved ones, whoever helps you make decisions about your mortgage. Obviously, talk to a VA loan expert here at Low VA Rates and take advantage of a lower interest rate by getting a lower term. That is how we win.